Will the everything bubble turn into an everything crash? And are you ready for the showdown? We'll chat to Ronald Peter Stufferly of financial services firm Incrementum to get his thoughts very shortly.
Welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Hello, everyone, and welcome back to Inside the Vault with SWP, a weekly show where we dive into the world of precious metals with the brightest minds in the space. If you're new to the show, you can find our previous episodes and other educational content posted on the Strategic Wealth Preservation YouTube channel. We have noticed recently that only half of the viewers of this show are subscribed to the channel. So please, while you're there, like, subscribe, and leave a comment or question about precious metals investing, and we will get back to you. Now, I'm your host, Jeremy Varlow. I'm happy to be back with you today and looking forward to our conversation with Ronald Peter Stufferly of Incrementum AG. He is also the co-author of the In Gold We Trust report. Ronald will join us very shortly, but let's kick things off with our weekly market update from CEO of SWP, Mark Yaxley. Mark, what's going on out there?
Yeah, thanks, Jeremy. Ronnie's been a prominent figure within our industry for some time, so really looking forward to hearing his thoughts on the market today. You know, as per the market update, unfortunately, things in the Middle East have not improved over the last week. The crew of a commercial ship was actually forced to abandon their vessel after being attacked by a Houthi missile attack in the Red Sea. This is significant because it's the first time that a crew actually had to be evacuated since the militant group started to attack trading ships within that vital area since late last year. And it only encourages the rebels to continue their attack. So something to keep an eye on there is an escalation. Public tensions persist between Israel and the United States over the Gaza conflict. The U.S. has proposed a UN Security Council resolution warning Israel against assaulting Rafah in the southern Gaza Strip, calling for a temporary ceasefire. In fact, Israeli Prime Minister Netanyahu, for his part, has vowed to push forward, ignoring repeated warnings from the U.S. and from other allied countries. Not much better in the Ukraine. Russian forces have gained ground recently in the Ukraine. Delays in financial aid from the United States are causing worry, particularly with the NATO countries. They've expressed their concerns about the reliability of continued U.S. support that they have traditionally relied upon to safeguard the region. More closer to home in the domestic United States, the U.S. dollar did fall 0.5% since we last spoke, but it remains above 104 on the U.S. dollar index, the Dixie. Investors are now awaiting the release of the latest Fed meeting minutes, which are actually scheduled to be released this week. And everyone is expecting a lower likelihood that we'll see the first rate cut in May. Instead, a 75% chance of the first cut in June has now been priced in. And finally, in the gold market, outflows in North American ETFs and silver ETFs, gold and silver ETFs, have accelerated since January, despite ETF holdings being at their lowest point since January 2020, which is basically pre-COVID bull market. Gold and silver are enjoying a modest rally at the moment. Gold up 2% since last week, and silver up about 4% since last week's update. Ending on a positive note, for gold, during the first month of 2024, wholesale demand in China recorded its strongest January ever, lifting the local gold price as well, the local gold premium as well. The People's Bank of China extended their gold buying spree to 15 months, and gold ETFs in China once again did attract net inflows. So some positive news for gold investors there. Jeremy, back to you.
Thanks, Mark. I think this is a great opportunity to bring in our guest. As I mentioned, Ronald Peter Stufferly is an Austrian economist. He is the managing partner of Liechtenstein-based investment and asset management firm Incrementum. He's also a recognized expert in gold, silver, and commodity markets. Ronald also co-authors the influential In Gold We Trust report. We're going to dig into that a little bit today, which analyzes gold's role in finance and monetary policy. Ronald, welcome to the show.
Thank you very much, Jeremy. It's a pleasure.
It's great to have you. I went through your report a couple times last night. The compact version, the full version is some 420 pages long, but it is full of really, really great stuff. And it covers so much about what we discuss on this show. We can sit here and talk about precious metals all day, but I think it's very important for investors to understand a bit more of the monetary policy and macro side of why they're in this gold trade. You titled this year's report Showdown. You provided 3 different showdowns that you foresee on the horizon. We'll start there and then we'll kind of work through each of those different showdowns. But if you can just, from a high level, tell us what those 3 showdowns are.
Yeah, well, actually, I have to admit that is our last Big in Gold We Trust report. We're already working on the new edition, which will be published on May 17th. But I think the leitmotif of showdown of our previous report is still valid, and we said there's actually a showdown in 3 different areas, which is first of all the showdown in monetary policy. The Fed was way behind the curve. They kept telling us that inflation is transitory and that it's only due to the Russian invasion in the Ukraine and so on. But then actually, if you panic first, they acted pretty quickly and much more decisively compared to the European Central Bank, for example. But I think if you would have told me like 2 years ago that interest rates will be at 525 to 550, while inflation numbers are coming down significantly, where would the price of gold be trading? I would have told you probably 1,500, 1,600, something like that. So the price of gold is holding up tremendously well. And from my point of view, the best is yet to come because, we crunch the numbers, how gold performs during recessions. A short answer is gold is a pretty good recession hedge. And how gold performs actually in an environment of falling interest rates. And that's also the best environment for gold. So that makes me pretty confident. The second showdown is when it comes to the topic East versus West, de-dollarization. We're writing about the de-dollarization topic for many, many years now, and it seems that it's really picking up momentum. So we've seen the BRICS meeting last summer in Johannesburg. Everybody was pretty excited that they will come up with a new gold-based BRICS currency. We always said, it's going to take time. But of course, there's so many bilateral agreements happening at the moment that clearly show us that the whole de-dollarization topic is clearly picking up momentum. And let's put it that way. Gold is coming back as a neutral reserve asset. So gold is really celebrating a renaissance as a central bank core holding. That's really crucial. I was in Dubai last November, and it's really staggering to see how important gold is, how much momentum there is when it comes to gold trading, to infrastructure, how differently people over there think about gold. Very much long term. They don't care about daily fluctuations. So my thesis over the last couple of years has been that the center of the gold trade is slowly but surely moving from the west to the east. And the third showdown that we described was actually the showdown in the price of gold. While we've been basically consolidating above the 2,000. We made a new all-time high in US dollar terms last year. That was kind of a short-term overshoot. But I think this consolidation is actually, I would say, this is a pretty significant development as we are seeing that, every dip is being bought. There's not too much downward pressure. And let's face it, who would have expected that gold would be trading above 2,000 in an environment where actually we're seeing significant outflows from gold ETFs. And I think that gold ETFs are basically representative for the Western financial investor. And those numbers are telling me Western financial investors couldn't care less about gold for the time being. But from my point of view, that's going to change. So that's, in summary, a short summary, the core views of our 420 pages report.
Yeah, and I can't understate how great the report is. Anyone who's watching should definitely go check it out. It'll be a couple of days worth of reading, but there's really some great material in there. I want to kind of start to peel back the layers of each of those three showdowns. Let's start with the monetary policy side of things, and you just mentioned from the price side of gold, you would expect it to be trading in that $1,600 to $1,700 range with the monetary policy that we have in effect right now. You cover interest rates, you cover the glut of liquidity in the market, creating this artificial boom over the last couple of years. But you also talk about the historical effects and the failures of quantitative tightening. Do you believe that the Fed can continue with this policy as is to get inflation down? Or will it send us into a recession or perhaps worse?
Well, I have to admit that we've been clearly in the recession camp. So we crunched the numbers in the last report. We said that a recession is on the horizon, probably fourth quarter of 2023. It didn't materialize yet. But I think from my point of view, if you have a look at the numbers, if you have a look at the leading economic indicator, if you have a look at the yield curve, probably the most reliable recession indicator, especially now that it's steepening, and the steepening is always the final nail in the coffin, telling us that the recession is coming. If you have a look, let's say a little bit below the surface in most economic numbers. If you have a look at the revisions that are being made, nobody cares about them, but they're important because they are the final numbers. I would still say that the recession is going to happen, and the longer we're seeing those levels of interest rates, I think that the more certain we can be that the recession is going to happen. Usually, the Fed really starts lowering and kind of starts panicking only if something happens. So I think one important thing to understand is, because many people say that high interest rates are hurting everybody. That's not true. There was a great piece by my friend Jim Bianco quite recently. He said that according to the Fed survey of consumer finances, about 90% of all assets are held by the people in the upper 10% of income brackets. So they basically own all the assets, and a good chunk of that is fixed income. So if you have a look at the liabilities, the bottom 50% of income earners have no assets, but they own over half of the debt. So this is the reality. The poor have the debt, the rich own the assets, and they are also responsible for roughly 85% of personal spending. So if rates go up, the poor are hurt. They get mad at the president, and his approval ratings, they tank. But the richer people actually make money. They buy stuff and they continue to advance the economy. So on an economy-wide basis, it seems that higher rates so far aren't hurting as much as people would have thought. But then on the other hand, I would say, if you have a look at, for example, the Bloomberg Commodity Index, if you have a look at the price of oil, if you have a look at the gold-silver ratio, for example, it's telling us that the economy is not doing so well. Over here in Europe, Germany is in a recession at the moment, and it just overtook Japan as the third largest economy, mainly due to the weakness of the Japanese yen. But I can tell you that the economic situation over here in Europe is anything but good. So from my point of view, it's pretty clear that this enormous fiscal stimulus, roughly 8% budget deficit in a year of full employment, that's mainly responsible for this high momentum in the US economy. But at some point, it's going to fade out. And I think, a recession is not something that you have to be scared of. It's just a reallocation of resources and a repricing of resources. But a recession is just normal with an economic cycle. But obviously, we've got an election year in the United States this year, so the Democrats will try everything to avoid the R word, while the Republicans obviously will try everything to talk the economy down.
Right. And I want to talk about that election cycle that we're in with you shortly. But you did mention something there at the top of your answer, talking about the yield curve being a great indicator. You also wrote about money supply in the 2023 report. Explain briefly to our viewers what that money supply and yield curve means, the historical implications of a negative annual money supply, and what kind of conclusions you can draw from that.
Well, let's talk about the money supply. We mostly look at the broader monetary aggregates like M2 and M3, because credit is the lifeblood of modern economies. So usually we're seeing positive growth of positive credit growth. Now and quite often, even if the momentum of credit growth weakens, we're moving into recession. But now we're seeing, for the very first time since the great financial crisis, we're seeing negative credit growth. So credit is actually contracting, which is a very, very negative sign. And of course, I mean, we're coming out of a historic period, the COVID crisis, the lockdowns all over the globe, and we've seen very, very extreme monetary and fiscal measures. But what I think it's really important to understand is, and that's what we're really pounding the table about for many years now. We called our, I think, 2021 in Gold We Trust report the monetary climate change, and there we described that actually politicians and fiscal policy has taken over from central bankers. And it's no coincidence that Janet Yellen, now is in the White House, and that she's a politician now, and she used to be the head of the Federal Reserve. I think this is quite telling. Of course, she has still very close ties to the Federal Reserve, but I think it's really important to understand that that during the COVID crisis, politicians actually, they kind of started understanding that handing out checks and fiscal stimulus and so on, it helps with the approval ratings, and it's people kind of get used to that, and of course, fiscal stimulus has a much more direct and a faster impact on GDP and on inflation compared to traditional monetary policy. QE is basically an asset swap, and it just increased asset price inflation, but we haven't seen any real effect on consumer price inflation. But now as credit is contracting, I think that's another clear sign that we are moving into a recessionary environment. And let's face it, if you're not one of the big banks, you're in serious trouble at the moment. And we've seen the regional banking crisis last spring, and now there's more and more banks coming into trouble. So those are already signs that there's serious trouble. Not only in the commercial real estate space, but I would say in every illiquid pocket of the market, be it venture capital, private equity, and so on. So this is clearly a sign that the economy is probably not doing so well as people would expect.
Thank you very much for that, Ronald. Very interesting. I was going to actually just ask a question about the regional banks. You covered that very well. It feels like we're kind of living in a bit of a Groundhog Day from last year, that the same issues are popping up all over again. Let's move on quickly to the geopolitical showdown side of things. Obviously, top of mind for everyone is Russia, Ukraine, Israel, Hamas. But in your 2023 report, you also cover emerging countries and economies, and in particular, BRICS in the report. In 2023, we saw new additions to BRICS, with many other nations wanting to join. On one side, we have certain BRICS members wanting to move away from the US dollar and de-dollarize, while others want to maintain solid relations with the US. What are your thoughts on BRICS? How real is the threat to US hegemony there?
it is clearly happening, but it's going to take time. And I think that we will before probably see more of a de-Euroization than a de-dollarization. I think, as my buddy Brent Johnson uses to say, it's the least dirty shirt, and it's the global reserve currency, that's a network good. And therefore it's like a language. How long and is it going to take that we will start speaking German or Mandarin or Spanish as the world language? And that's going to take quite a long time. It's going to be costly. It's going to be complicated. It's going to be messy. And people will ask, okay, what's the advantage? So actually, the new system has to be like 5 or 10x better than the old system. So therefore, I would say, hold your horses. It's process. It's gonna take a long time. But clearly, we're seeing that emerging markets are not really happy with the status quo, and with the BRICS, they're just one part of the whole de-dollarization story. It's also the SCO, the Shanghai Cooperation Organization. We're seeing for the BRICS, for example, I think it was interesting that Argentina said, no, we're not gonna join. We're more in the dollarization camp with the new president Milei. But still, the BRICS, with including the new members, they will be responsible for 46% of global population, roughly 50% of energy consumption, and 52% of oil production. So I think we should take those countries serious. And as I've said before, talking to people in Shanghai, talking to people in Mumbai or in Dubai, it's really staggering what kind of view they have on gold. So I think that gold plays a major role in that whole de-dollarization topic. We're seeing obviously that this enormous supply of U.S. treasuries, it's not being gobbled up by Saudi Arabia and China anymore. To some degree, it's Japan, but primarily it's private investors, it's institutional investors, and also European investors from the institutional space. So of course, this also has a big political impact. And therefore, I think it was really, really interesting to see what when Donald Trump became president, his first visit was to which country? Do you know?
I don't recall. No.
He went to Saudi Arabia, and that's quite telling, I think, because that's just from a geostrategic point of view a super important country. We don't know. I don't. The election, I think nobody's really looking forward to that. It's gonna be messy and it's gonna be dirty. But if Donald Trump is gonna make it, I don't know how the world is gonna change again. But I think that Donald Trump really understands the importance of Saudi Arabia for the status of the petrodollar. So. Short summary: gold plays a major role for those BRICS countries. The majority of the central bank demand is coming from BRICS countries. 50% of private consumer demand is coming just from China and from India. Indian housewives alone own more gold than the US holds in Fort Knox. So I think it's really we should be a little bit in the Western world, a little bit less arrogant and think that we're like the center of the gold world, and really, really travel to those countries and just experience and feel and smell how important gold is actually over there in emerging market countries.
Yeah, I saw your interview with Kitco Mining from a recent conference where you said exactly that. The rest of the world has a very different relationship with gold than the West does. And,
yes.
And I found that really, really interesting. And that takes us into the gold showdown part of things. Obviously, you mentioned at the top of the show that gold outperformed what, your expectations were in 2023. given that, what do you expect for 2024? Obviously, we're all kind of waiting on, the Fed to start cutting rates. Are there any other catalysts that you're looking at that would move the gold price in either direction?
I would say that, I think that we're always pretty quick to criticize central banks, but actually, they've been helping. Again, the Eastern central banks, they've been really bailing out the gold market last year. They bought more than 1,000 tons of gold. I think 45 tons short of the all-time high that we saw in 2022. And normally those buying programs are really long-term programs. So we will probably continue to see good demand coming from the central banks. What's really going to move the needle will be investors' demand. I think that once we hit new all-time highs in dollar terms again, and we're not too far away from that. Yeah, it's like $80 at the moment. Then I think some momentum will kick in, and then I think this could really move the market to 2,400 pretty quickly. Can I rule out that gold will trade lower over the next couple of months? Perhaps, because inflation will prove to be stickier, as we've seen with the last CPI print, and that means that we will not see market participants expected at the beginning of the year 7 rate cuts, but perhaps just 1 or 2 rate cuts. That would be a big disappointment. And then, of course, you've got high opportunity costs of holding gold, and I think that could really dampen the performance of gold. So those are considerations that I would say, but actually, if we take a step back, actually, I really don't care about the daily fluctuations. I think that gold, for me, it's not a religion. We're asset managers. Gold is an important pillar of our strategies, not only in our investment funds, but also in our wealth management strategies. And I don't know what your favorite sport is. For me, it's obviously football, so soccer. So I think that gold is really like a solid defender in your portfolio, like Paolo Maldini, or like a good goalkeeper like Walter Senja or Gigi Buffon, something like that. It's necessary to have that in your portfolio. But that doesn't mean that you should only have defenders or goalkeepers in your portfolio, obviously. So I'm always a bit hesitant when it comes to gold being labeled as, the solution for everything and the answer for all our problems. It's not. But I think that gold worked extremely well over the last couple of years as an inflation hedge, as an equity hedge. It performed well in times of negative real interest rates. And as I've said before, I think the fact that gold is holding up so well against this headwind of rising interest rates, of rising real rates, I think this is an enormous sign of strength, and that makes me really, really confident. So yeah, I mean, we'll see. I just tweeted out the chart in the chart of gold in Japanese yen terms. I mean, that's a beauty. Yeah, I mean, that's just the perfect uptrend. But if you actually change your perspective, what does it mean? It means you need more units of Japanese yen to buy 1 unit of gold. And this is really the important thing that you always have to have in mind. It's actually not the price of gold that is really moving. It's just the purchasing power of fiat currencies that is falling. And for us here in euro terms, I think gold was up the last 6 years in a row. In Swiss franc terms, obviously, the Swiss franc is one of the least, one of the I would say one of the strongest fiat currencies. But still, gold is outperforming the Swiss franc. And we're not talking about those really, really weak currencies, in Turkey, Vietnam, or obviously Argentina, and so on. So I think gold is doing its job perfectly well. And therefore, if it goes down to 1900 this year, I'm pretty happy. I'll buy more. Um, will this year be the year of the big breakout? I'm not sure, but I think it will go in hand with the rate cut cycle, and probably also at some point, I think that the Federal Reserve will have to start panicking, because I don't know if there's something happening like a black swan event, or the recession that is developing at the moment. So that makes me, as I've said, pretty relaxed, I would say.
Listen, super insightful. That was a great answer. This has been a fantastic interview. I had, a list of other questions to get to, but I know you have other commitments, so we'll have to plan to do this again. It's very hard to condense a 420-page report into a 20-minute interview, but we tried our best. But we'll definitely have you back on the show. Ronald, just in closing, if you can just give some details to our viewers on where they can find the In Gold We Trust report, where they can follow you on various social media outlets, that would be great.
Sure. So first of all, thanks for having me. Really enjoyed that. Well, our report is available free of charge. You can download it. You don't have to register or give us our email address or anything. Just download it on ingoldwetrust.report. It's available in German, in English, and also in Mandarin and in Spanish. We've got monthly chart books. That's the Gold Compass, where we send out our favorite charts from the gold and the macro world, but also, of course, silver, inflation, and so on, mining stocks. Then we've got specials like the gold beer ratio that shows you that gold protects your purchasing power at the Oktoberfest in Munich. But we did the same one with ski tickets. So actually everybody is complaining that the ski tickets are becoming so expensive. Measured in gold, actually you can increase your purchasing power on the ski slopes. So those are the kind of fun publications that we do. You can find everything on ingoldwetrust.report. Our funds, we manage 6 investment funds, and we do wealth management for institutional players and high net worth individuals. You can find everything on incrementum.li, which stands for Liechtenstein. And then I'm also tweeting out random stuff, charts, macro, but also, music, but also, movies, and of course, sports. On my Twitter feed, it's at Ron Stoefelle.
Awesome. Thank you for that. You hit me right in the feelings with the ski lift pass thing, because now my favorite hill, which is Whistler, is $300 for a day ski pass, which blows my mind. But nevertheless, thank you very much, Ronald. I appreciate your time, and we'll definitely be having you back on the show.
Thank you very much, gentlemen. Enjoyed it. Thank you very much. Take care.
All right. With that, let's jump to our ending segment, Bullion Basics. We'll bring Mark Yaxley back. What have you got for us today, Mark?
Yeah, thanks, Jeremy. What a great interview with Ron. Some great questions and some really amazing answers. Definitely going to check out his work a little bit more in depth when I've got a few days to kill. With tax season coming upon us, I thought it'd be a good time to talk a little bit about precious metal IRAs. We did a recent survey to our own clients at SWP, and we realized a lot of people didn't yet realize that you can actually hold physical gold and silver bullion in what's called a self-directed precious metals IRA. So I just wanted to introduce the idea to people. And basically how this works is you set up an account with a qualified and regulated IRA custodian, which would be based in the United States. SWP has partnered with 2 such custodians, Advanta IRA and Preferred Trust IRA. And then you are able to buy your favorite physical gold and silver coins and bars that you probably already invest in if you're watching this podcast anyways, from a dealer like SWP, and those can be held in either a traditional or Roth IRA account, which offers you some distinct tax advantages. Not only do you benefit from the long-term appreciation of a precious metals investment, but you also couple that with some favorable tax benefits that differ a little bit, whether you invest them in a traditional IRA or the Roth IRA. So basically, Jeremy, I'm just encouraging people, if you haven't already, you're probably going to want to educate yourself on what a self-directed IRA is. And then one step further is the precious metals aspect and including precious metals in a self-directed IRA. We have a dedicated page on our website that talks about this, and we've also done videos on our YouTube channel previously about it. You know, it is that time of year, and there's still plenty of time left for people to get set up and to make a purchase that would qualify for the 2023 tax year.
Awesome. Thanks for that, Mark. That is all for us today. Thank you so much again for watching, and to Ronald Peter Stofferle for joining us. Make sure to check out his In Gold We Trust report at ingoldwetrust.report. There is both the full version and the compact version in a few different languages, as Ronald mentioned. There's a ton of great information there that could make anyone a macroeconomic expert at the dinner table. And lastly, head on over to the Strategic Wealth Preservation YouTube channel for all the information you need to know on precious metals investing, or email us at info@swpcayman.com, and a member of our team will happily assist you. Until next week, stay safe and happy investing.
Thank you for listening to Inside the Vault, the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show. See you next time on Inside the Vault with SWP.